Well, good evening, everybody, and welcome to the May 2022 Roundtable Top Gun Maverick Edition. Stock selection, best of the best, all the stuff that goes with Top Gun and Tom Cruise and all that kind of stuff. My name is Mark Robertson. I am joined here by Ken Kavula. Good evening, Ken.
Good evening, Mark. Glad to be here this evening. It's been a long day, but a beautiful day up here at least.
Sure has. It's been pretty good down here, too. And we're also joined by Cy Lynch from Atlanta. I'm sure that Cy's doing pretty well with his Braves continuing to do fairly well.
Yes, they're struggling a little bit with consistency, but they're doing all right. They'll come around.
Good to hear your voice. And we're joined again this evening from Houston's Matt Spielman. Good evening, Matt.
Good day. Hey, Mark. Hey, everyone.
And again, we basically come together. We've all been involved in investment education for a number of years. Most of us know each other going back into the 90s. And our mission here tonight is quite simple. It is a Top Gun mission. It's simply share one of your best stock study ideas at this time, and that's what we're going to do. So we'll take a look at some results and see if we can't go ballistic. I don't know if that's a good thing or not. Anyhow, we're going to try to soar, continue soaring. We'll talk about how much we soar. All right. Just real quickly, there's a lot of familiar names in the audience. Welcome back. Those of you that haven't been here before, we do try to keep it fairly informal, but please know that no investment recommendation is intended. Everything that we do here is intended to demonstrate and illustrate the methods and techniques of the modern investment club movement as championed by NEIC, the National Association of Investors, also known as Better Investing now. And we basically try to glean those lessons learned over approximately 8 decades as to how to be a successful investor and share them here. So you're going to hear opinions from us. Please do your own homework regarding any stock that is mentioned or pops into your head as a result of what we talk about. And if we do own something in our personal portfolios, we do try to remember to disclose it. You can be added to an email reminder list about this monthly webcast by sending a note to Natalie Kavula, that's nkavula1@comcast.net. And if you have copies of the slides or follow-up questions, if you'd like them, our 2 email addresses are at the bottom. Anything else we need to cover, Ken?
No, I think we're ready to get going, Mark.
All right. Here's our basic agenda, our standing agenda that goes back approximately 10 years now for this, almost 12 years now for this monthly webcast. Again, welcome. Good to see a lot of familiar faces and names. And those that are not out on their nice walk in this good summertime weather with the official start of summer yesterday. So welcome back. We are going to take a look at our performance results, and they are soaring a bit, so we're happy about that. We'll take a look at the type of selling considerations we do for portfolios with our feature called the hot seat or the challenge stocks. And then you see the 4 updates. Kim Butcher is unable to join us tonight due to taking care of some family matters. And she was going to mention the VMware, that actually will come up when we talk about stocks that have been hot. And Cy, you can probably cover that one. I think that's one of your nominations going back, a selection made a couple years ago, VMware.
Right.
And Matt will do Borg Warner, and I'm going to actually, in honor of tonight's theme, do a little targeting. There is a poll at the end. Even if you're here for the first time, you're welcome to vote, and we do try to leave some time for Q&A. So with that, here's just a reminder of why we're here, just to share an idea. And we do welcome core and non-core selections. We try to keep the non-core selections under control. I don't think we really have any of those tonight. The goal is to build a portfolio that beats the market by 5 percentage points. And we'd like to see the majority of our selections outperform the market since the time of their selection. So that's what we've been doing now for, it'll be 12 years in July, so coming up. Here are the results. and they're quite good. It's kind of fascinating to watch our results actually get better relative to the market as the market drops. I find that kind of fascinating. And we do stand with a rate of return, an absolute rate of return, which has dropped a couple percentage points down to 16.3 that you see here. So that's 16.3 that you see up at the top of the page, but the market's actually dropped even more. So we now have a relative return of the 6.1. That's the point that you see plotted right there. So again, the rate of return that we've achieved minus what you would have received just putting the same amount of money at the same time into the Wilshire 5000, and that's the relative return that you see achieved. So we are going a bit ballistic here. Any comments or questions at this point, Ken?
I'm happy to see our performance accuracy inching up also, Mark. That's a nice thing for us to have happening too.
Yeah, it almost rivals what we saw approximately 5 years ago coming out of that other kind of nasty period in the market. I'd like to see that same magnitude achieved this time around too. Pretty good stuff. All right, and again, our performance, about half of our selections have actually beat the market after their time of selection. All right, so pressing on, here's the actual portfolio. You can actually look at all of the selections. There are 70 or 80 positions in the portfolio. This is a public link down at the bottom if you want to see every single position. What you see on your screen now is the top 20 by percent of assets, Microsoft being the largest in the tracking portfolio, down to number 20, T. Rowe Price. The legend up at the top is basically the key to how many times these have been selected. So in the case of Microsoft has been selected 5 times, and every time one of us or the audience or a guest damsel picks a company and makes a selection, we invest $1,000 into it. So $5,000 invested into Microsoft is now worth $69,000. Now that's come down a couple thousand since last month, but that's basically how you use that key. So you see a number of companies up there that have been chosen several times. The most frequently chosen company is Cognizant, and I just have this feeling that Cy's getting ready someday to choose it again. Because he likes those information technology companies, and he's responsible for a number of these that are doing so well at the top of the portfolio. So
after watching Booking move up this list, Mark, I'm very glad that we gave it a pass about 5 or 6 or 7 months ago. It certainly has warranted our faith and has paid us back handsomely in return.
No, the same is true with EPAM. I mean, there were a few people that had an itchy trigger finger there for a while, and we hung in there. And hanging in there with a high-quality company with a decent growth rate is usually a pretty good idea.
Yep.
I see your Maximus is on here too now, Cy.
It is coming up, isn't it?
Information is apparently king. All right, so those are
we can't leave this list, Mark, without noting that single position in Costco still holding in the top, I don't know, 15 maybe, top 16, right there. That's only one-time choice of that stock. Maybe it says that Costco isn't a buy very often, and maybe there should be special rules for Costco and 1 or 2 other stocks in the whole universe of stocks.
Well, I actually bought some Costco about 1.5 years ago, and it's done extremely well in that time frame until lately. I mean, it's come back quite a bit also, but yeah. I every time I go into Costco to grab 1 or 2 items, I walk out with a $300 bill, so I think I understand how their strategy works.
You got to stay out of the bakery aisle, Mark, okay?
Well, I'll tell you what gets you is meat and coffee.
Coffee, okay.
Okay, enough. So these are the 20 companies that are at the top of the tracking portfolio. Keep in mind there's another 50 or 60 positions off the portfolio that have been selected, generally fewer times. But Most of them are in the green or in the black, however you want to think of it. All right, so here's our challenge process. Basically, what companies are on the hot seat. What we do is we take the entire tracking portfolio and sort it on our manifest dashboard from lowest projected annual return to highest, and again, focusing in on the ones with the lowest projected annual returns. We don't have any that are terribly low. We don't have any that are close to zero, which is basically the time when we might think about selling them. And pretty good numbers from top to bottom here. Even Biogen at 3.7 does not scream sell me. I mean, that's a little bit of a different company. But your thoughts, Ken?
Well, I'm always drawn to the growth column, Mark. It's sort of in the middle of the pack right there, and I'm watching the growth of that sales growth, folks. The growth of the entire tracking portfolio, and it's 11.3. Nicholson wrote a number of times that growth of around 12.5% should be able to result in a portfolio that beats the market by 5 points. And that's our goal all the time. Our par right now, our potential is 13.8. The average is 10.5. I'm reading that off of my par up there. But 10.5 and 5 gives me 15.5. So I know our potential's a little bit on the low side also. It might not be a really bad thing to look at what's going on in some of these and to maybe kind of focus on the Biogens and the Gileads and maybe even the AbbVies of the world with their extremely small growth. I argue with myself, however, because those represent an extremely small piece of the whole portfolio. You can see that Biogen's only 9/10 of the portfolio, and Gilead's less than half, and AbbVie's less than 0.5%. So I don't like these slow growers in here. At the same time, I don't know how much gain we get by eliminating them from the portfolio. What do the rest of you guys think?
Everybody's bashful.
Silence.
Well, I mean, I do not disagree with your points on low growth. That low a growth, I think, is too low. But again, selling them doesn't make much difference.
Yeah.
I mean, that's the point that you made. Although nothing, while this is not a managed portfolio, there certainly is nothing that says that we can't just do a little house cleaning and sweep them out and show the example also of what you would do if you held it in a managed real money portfolio.
You know, the thing that makes a company like Gilead tough, and Hugh has actually done some excellent work on this company, is the problem with Gilead is they put themselves out of business, and they actually cure things, and so they don't create a perpetual need for their medications, and that's a real problem. I think Biogen has that also to some degree, so you almost have to treat them a little bit differently. But I agree. You know, one of the other things that we've noticed over the years is we try to keep that par above my par sometimes, and especially right now. I mean, our portfolio performance is so strong that it keeps driving that par down.
Yeah, those are the kind of problems we've been having for the last 4 or 5 years, not only in this portfolio, but in the real portfolios that I sit when I watch my clubs too. We're constantly having to look for stocks to try to push the par up because I know it's a terrible problem to have, but when you pick good stocks and they really do well in the market, that drives their par the other direction. It drives it down. So maybe Cy's right. Maybe we just make an example of Biogen and Gilead and move it out of the portfolio just to show that we would like to move that growth up. I don't know if it's going to touch that growth at all, but maybe it's good house cleaning, and Maybe next month we look at the 3 and 4s in the portfolio, Mark.
Okay, so I will put together.
There's a good comment from Len Douglas too, looking specifically at Biogen. Is right now its quality rating is pretty low too, and a number of those are lining up, and a lot for the same reasons. But for both Gilead and Biogen, that's not adding to the number either.
Good point. So we'll do a quick case study on that and give that some thought. The second thing that we watch fairly carefully is any stock that is for whatever reason really lagging the market since the time that it's added to the portfolio. And we actually have a fairly short list here. And anytime it drops below 20, it's not an automatic sell. Ken and I have done a number of presentations on this, but it is kind of a trigger or a timeout, or definitely do an analysis of the company to see if there's anything fundamentally wrong with it. And stop me if I'm off base here, Ken, but what I did is I took and put the 4 companies up to display their return forecasts, their quality, their projected return on value, and basically some opinions from the other third-party opinions out there. And I have a hard time, really going after any one of these, even though their prices are down. I mean, PayPal is down mercilessly.
The only one, Mark, that I could make a case for, I think, would be the construction partners with the really low quality rating. Mm-hmm. We know that the company is fairly new. We know that it's never been through a recession before. We know that it's on the small side, and that's the only one I could even begin to make a case for at the moment, at least. I really think that Meta Platforms or Facebook, whatever you're going to call it, and it's going to change its ticker in 3 or 4 days, and that's going to compound the confusion with the darn thing. But I still think that that's an investment that you should be very serious about taking a long, hard look at. I just don't think that it should be trading where it's trading right now with the kind of growth that it has. And I think people are searching for reasons why they can't like it, and they've turned it into perhaps the whipping boy on behalf of a huge section of the market.
Yeah, and I mean, these numbers over here for the analyst consensus and for Morningstar basically confirm that the fundamentals are intact pretty well for most of these companies, and they're just getting pummeled stock price wise. I mean, look at Boston Beer, and we've talked about that a number of times. But I could see where Construction Partners is more of a candidate to unload, just simply because it's again in the protective measure that this rule can actually give us from time to time. Could be worth some consideration also. All right. So do we sell Construction Partners?
I would tend to, and one reason is just from a little bit different take than Ken was saying. I have been relatively skeptical of the relative return rule of 5 application. I mean, I understand rule of 5 and have no problem with the fact that you blow it sometimes. But our whole methodology is built on buying high quality companies selling at good values. Now, there are exceptions to that. There's our friskier parts of the portfolio where we relax the quality somewhat or go a little bit more speculative, and that's fine. But part of, I've always felt if Meta, for example, or Facebook was a high quality company at one price, excuse me, and nothing has changed in its fundamentals, arguably it's an even better value at the lower price relative to the market. That's been my struggle with this methodology. Y'all have heard that before. However, Construction Partners doesn't fit that model. It may be that it's underperforming the market significantly because it is of lower quality and is getting punished in this down market and questionable period of time, and it may not recover, or at least recover as fast.
I'll admit also, Cy, that the rule of five that we've been talking about here isn't nearly as clear cut to me during this market that's really volatile as it was when we were sailing through a market that was moving in a single direction.
Yes, that's another excellent point.
Yeah,
yes.
it made a lot more sense when we had a market that was, and I'm going to put quotes around the word behaving, because it really wasn't behaving, but it was doing something that we thought was that we enjoyed. So we didn't really pick on it very much. But when you have a market like you have right now, I think that the price volatility should be something that we're celebrating by looking at low price sometimes and deciding that the company's high quality. There's really nothing wrong with it, except the market doesn't like it at the moment, and we have a 5-year time span to solve that problem.
Mm-hmm.
So
I guess I would agree. I mean, when it comes to construction partners, they're largely in infrastructure and asphalt stuff in the Carolinas and several other states, including parts of Canada, I believe. It's hard to imagine how these guys have lagged so badly during, I don't know if you drive on the roads in Michigan. I mean, asphalt's a pretty in demand commodity around here. I don't know.
Well,
They're not performing in a market where they should be set up to excel.
and isn't part of it, Mark, that we pass a bill in Congress, witness the infrastructure bill, and we expect that money is going to begin to flow right down to projects immediately. And in fact, there's a significant lag in that money going anywhere. It might be as long as a 1.5 to 2 year period before a lot of projects even begin to see the green shoot of any of that money. So this was a great idea, but maybe a great idea way too early in the cycle.
Could be. All right, we'll take a closer look at that one also. And here's just another one to bring to the audience's attention. Cy brought VMware, as has Kim, over the years, and it's the only one in the portfolio that is anywhere near an overbought relative strength. And the reason is they basically have a purchase offer somewhere around $140. Do you know what the purchase price was?
I think the cash is $142.50, something like that. But then there's a 50% is going to be you can elect either way, but it's pro rata, 50% cash, 50% Broadcom stock. And I think the weighted price is, as you were saying, around 138 or so.
Okay.
A share at the current Broadcom price. So you could see the market has some doubt about the deal going through, even though they have a majority pledged to vote in favor.
Yeah, and I guess I'd like to hear thoughts from Ken and you, Cy, on if this one falls apart, does it fall way down or does it remain elevated, because it seems to be a low bid price for the company?
I'm sitting in a club that owns VMware, Mark. B.I. Baker owns VMware, and that's going to be number 1 or number 2 on our agenda 2 Tuesdays from now. And I think that our discussion is going to revolve around the fact that we didn't see we were kind of waiting until VM spun itself away from Dell, or until Dell kind of pushed it out on its own to hobble around. And we kind of thought that there would be some improvement, and there was improvement for a little bit. You can see the upward tick when Dell pushes it out. But then it's been moving in the other direction essentially since that point. And I think our discussion is going to revolve around, do we take the money and run and find something that's not nearly as difficult to analyze? And I think that's where we're going to settle. It's not going to be based on how good or how bad a company VMware is, but it's going to be based on the analysis of the company, which is not the easiest thing in the world to do for VMware.
Mm-hmm. All right. So
and I think short term, that's probably certainly a good approach, because to answer your question, Mark, I would not be surprised if for some reason the deal does fall through. While it certainly is a low ball offer in many respects for the company, I expect you're going to see it go back to the pre-offer or pretty close in the near term.
Mm-hmm.
Now, if you want to hold it, year, 2 years, 3 years, it may come back up to where, is a much better price. But
yeah, VMware does all kinds of great things. It has a really good story behind it, but it's not a stock that you want to try to wade into, because it has very little history of being on its own recently. It's been kind of protected by Dell Computer, and then suddenly kind of released into its freedom to do what it needs to do, and the market didn't really care for it standing alone. So.
Yeah, it'll be interesting to see what your club decides to do, and maybe it comes up for discussion again a month from now, because I think it's a low ball offer. I don't see a catastrophic drop if somebody walks away from the table, and I wouldn't be surprised to see a competing offer come in either.
Well, this is about plus $34, $35, isn't it? Is that what I think? That's where the numbers we were dealing with in Baker, and that's if you own a couple hundred shares, that's a decent amount of money to put to work somewhere else where you have more clear-cut analysis going on.
Well, this is definitely one that is on the leaderboard for both Kim and Cy in terms of performance since their time of selection. So sometimes it's just good to high five around the water cooler and move on to the next win.
Yeah. And the thing is, again, at least on this offer, you're looking at what, 7% or so on the upside to hit that 138 or 142.
Mm-hmm.
And even if it doesn't catastrophically drop, the 40% or so that it went up when the rumors started, even if it just gives up 10 or 20, what's the upside downside ratio?
Right.
Go ahead and buy it now. I mean, sell it now. If the deal doesn't go through, buy it back after the deal falls.
Yeah, that's quite likely to be a short-term ceiling or resistance for sure.
Right.
Yeah.
All right. We'll keep moving on. So let's go ahead and move to our stock selections. It's got about 9 o'clock, so it's time to move on. And Ken is going to quadruple down on Google.
I'm going to bring back Alphabet, Google again. The official name of the company obviously is Alphabet, but it still goes by the stock ticker GOOG or GOOGL. And I'm going to do something that haven't tried for 8 or 9 years. I presented this stock in February, so I'm going to show you my February slides and then follow them with an almost identical slide today. Here's the situation for Alphabet back on February, the February roundtable, which would have been the last Tuesday of February. And notice the quality of the company at that point was 99 with a par of 20.8%. Keep that number in mind. It's going to come back for us to discuss in just a little bit. The stock price on 225, that was the last Tuesday of the month, was $2,690, almost $2,700. Now, this was well into the beginnings of the market disruption. Alphabet had already fallen a significant amount from some much higher values. And so we were looking at a stock that was already, I thought by my analysis, going to give us a significant upside if in fact it held itself together. Now here's the same slide for today. It's coincidence, folks, and Mark and I have audited this value. It's coincidence that the par value has stayed the same because the stock price has fallen to $2,255 from where it was. Again, it's coincidence that par value is 20.8. There's an extra quarter in the data between February and now. There were some changes made in the analyst consensus opinions about PE values going forward, about net profit numbers and things like that. Mark put together a then and now kind of a comparison. You can see that sales growth by the analysts was downgraded a touch. The proved value actually went up just a little tiny bit. The net margins were down again from an excellent 32% to a pretty decent 29.9%, but down nonetheless. The projected PE ratio down a tick from 26 to 25. Google had already kind of readjusted its PEs, in my opinion, and wasn't going to be significantly readjusted by the market. At least that was my thinking in February. The par value 20.7 to 20.9, and that's there's a couple of days difference in there between my figures and these figures. So that fact that the par stayed the same is a coincidence, but a lot of potential in this particular company. That's why I'm choosing it. Here's your graphs. That downturn is the Jobs Training and Partnership Act, the big tax disruption back in 2017. This is a classic up, straight, and parallel. A lot of pluses coming from the COVID pandemic. The business increased much faster and the earnings increased much faster. You would expect there to be some pullback, that they pulled some business forward, and now they're not going to grow quite as fast going into the future. But it's a beautiful, beautiful picture. Next slide. That was in February. Here's March. Not much has changed except the extra quarter has come in, and you'll notice that while their sales increased at 23% year over year on that new quarter, their earnings actually dipped a little bit, down 6% quarter over quarter. The folks on the Alphabet earnings call didn't seem particularly worried about that dip. They knew that their earnings had been somewhat inflated by that 2021 call, and they are still very optimistic about total growth during the particular fiscal year of 2022. That -6 didn't seem to bother anybody at all. The estimates have changed a little bit too. These are Morningstar ACE estimates, and the most recent ones are a 2-year sales call of 13% and a 5-year earnings call of almost 25%. Next slide, Mark. Here's back in February where I made the sales call of 17 and the earnings call of 20. I felt that they were significantly on the conservative side of the sources that I use to do my research. I felt they were realistic for this very large company, although they are really ambitious for a company this size. Remember that most large companies were very happy if they grow in the 6, 7, 8% range. So to see a huge company growing at these numbers is exceptional. I did eliminate the 2017 data from the PE array because of the tax issues involved. Those numbers aren't very reliable. And then I used about 29 and about 17 for the high and the low average PEs going forward. Now move it up until tonight, and I've dropped my calls to 15% for both of them, for sales growth and for earnings growth, and I've reduced my PE values. I've kept the 28 at the top. I'm sorry, the 28 was what I had, and I've dropped that to 25, and the let's do this again. I've kept the 28 at the top, and I've moved my bottom PE to around 15, and that's a little bit lower average PE than Value Line expects 3 to 5 years from now. Value Line expects about a PE of 25. My two PEs give me a 43, and you divide that by 2, that's 21.5. So I'm being I'm setting a much lower bar for the company to have to move itself over to meet my expectations going forward. I'm devising this very, very conservative SSG, and I'm interested in looking at the results from that SSG, because if the results still say buy, then I figure most of the surprise will be to the upside, which just makes it a better buy. Next slide, Mark. Here's back in February, where my buy was giving me a total price appreciation of about 200% and giving me about a 7-to-1 upside downside. And here it is today. I'm down to 176%. Folks, these are phenomenal numbers. I'm down to an upside downside of 6-to-1. Remember that the sources that we're using are suggesting that earnings growth for the next 3 to 5 years are going to be well into the 20s, somewhere around 22, 23, 24, 25%. And I'm doing an SSG based on earnings growth of 15%. Surprises? They're going to be to the upside for the most part if they happen. At least that's the bet that I'm making. Next slide, Mark. Google does not pay a dividend. In February, the total return was about 25%. The par, the number that I focus on, was about 19%. Now, next slide, it's moved down to 22% and 16%. Again, just outstanding numbers for a company this size. I'm not as optimistic as the analysts that provide the data for Manifest, but I still feel the potential for this company is superior, especially when you consider how large the company really is. One more slide, Mark. Here's some values coming from Manifest, some projected numbers, 3 to 5 year total return, high side, low side. Here's the annual rates box, and you can see Value Line is at 18.5 for their particular 3 to 5 year. And I really like the last paragraph of the most current Value Line report, which is only a couple weeks old. It did come out after the quarter earnings that came. It suggests that in the near term, the timeliness ranking says Alphabet will outpace the market, and they also like it very much for the longer pull of giving above average capital appreciation out 3 to 5 years. It's a very positive statement from a very conservative source, namely Value Line. I think there's one more slide, Mark. I feel that my judgments for the study are extremely conservative, much more conservative than I would normally do, and therefore better than average news should have a positive impact on my results. In my opinion, I think this is really a very, very undervalued stock, and I'm recommending that we put another position in the portfolio.
Okay, just so what you don't say what's not to like, because I actually own this one.
I didn't say what's not to like in it, Mark. Okay, all right.
All right, let's switch to Texas Roadhouse and some steaks, and what's not to like about their steaks.
Absolutely, and I'm surprised that Ken did not lead with the big news on Google, which is its 20-for-1 stock split. We know that always makes money.
Well, I put that on the Value Line for people to read, but I don't like to talk about it too much.
I really
just
don't
gives
like
me heartburn. This gives me heartburn, Cy. Okay.
Well, I had the remedy for your heartburn: a good steak.
All right.
At Texas Roadhouse, maybe throw some peanuts on the shells on the floor or something. I decided to take another look at Texas Roadhouse. We looked at this a couple of years ago and added a one holding that is still in the portfolio. You can see what really attracted me to it primarily is the very consistent sales and earnings growth with quite consistent pre-tax profit there. Those numbers from Value Line are off the paper report, but Value Line is looking at a potential midpoint return in the near term, 18 months of possibly 40% and a decent long-term outlook as well. And that is roughly the same price as today's price. I think it's a few dollars lower on the Value Line report, but nothing drastic. Next slide. I just took a look at the portfolio ranked by par, ran down just visually at some of these companies. I didn't want Mark to accuse me of making MKS Instruments the next Cognizant. So we figured we would hold off, even though that's not information technology. We'd hold off on that. Five Below, a retailer. I was kind of in the retailing food service mood. Five Below certainly has some potential there. And you see Starbucks, all of these companies, along with some of the others, also showing a bit of a bounce back from COVID depression because of the nature of the business that they're in. And you can see Texas Roadhouse, it's fairly high on this list, so I said, let's look at it further. Next slide. Excuse me, taking a look at a screen of the entire manifest database of roughly Texas Roadhouse's criteria, 17 par, a little under, slightly under the quality, used the same financial strength, the growth and earning stability. It gives you just 6 companies, one of which you just heard a little bit about, ranking them by PE in reverse order. You see that Texas Roadhouse has the second lowest projected PE. So that's not really looking at necessarily what the current PE is or how it compares to historical or projection. It's just, for me, it gives me a little bit more confidence in projections that don't rely on a very high PE. To be very honest, none of these companies are particularly high PE for the quality and the growth that you're getting. Next slide. And then finally, do a quick industry study in comparison. I like ranking the industry by quality, looking for the best of the best. And again, you see Texas Roadhouse is right up in the top quality for the restaurant industry, and also one of the top companies combining return and quality. Next slide. Here's what the company's about. Their founder and longtime chairman, who just passed away the last year, say we're a people-first company that happens to serve steak. They started in 1993 and have grown to over 670 restaurants. Most of them are company-owned. Excuse me. They do have some franchises, particularly overseas. I give you a little bit more detail in another slide on the difference between the 3 restaurant concepts. But of course, the steakhouse is Texas Roadhouse, which is the majority of the company. And then they have Bubba's 33 Sports Bar, which is where they're putting a lot of their emphasis on potential expansion and growth now. And then they are also working on Jaggers Fast Casual. One thing that is not in the slides, and I will mention here, because the Jaggers Fast Casual, I think, plays up to it a little bit. They're trying to apply some of the lessons that they learned in COVID operations. they are working much harder now in really emphasizing ordering through the app, digital business, and pushing more takeout or getting on the waiting list, getting in line at the restaurant through the app, which were innovations that they particularly emphasized during the times when they were either restricted from having dining rooms open in some locations or lower capacity and the like. And I think that Jaggers offering drive-through and carry-out as well as dine-in is just another continuation of that trend. They're looking at how can they give the same quality of service and meals maybe in a little bit different environment. Next slide. Just a couple more pictures from the annual report. Legendary food, legendary service, and an emphasis on team and family. Next slide. Here's the Texas Roadhouse and the Bubba's 33, a little bit more description about what they are. Roadhouse being the steakhouse with some other assorted items. Bubba's 33 being a sports bar, sports restaurant with a fairly typical sports bar menu. The one thing in all three concepts that Texas Roadhouse emphasizes is their made fresh, made from scratch techniques or approach to the food. Next slide. And then here's a Jaggers that exemplifies that somewhat, serving burgers, chicken tenders, and chicken sandwiches prepared to order, and then salads also that are prepared to order, which certainly is not unusual for even a casual full service restaurant, but preparing everything to order for fast casual drive-throughs and the like, that's not uniform. And they tend to open 25 to 30 locations a year. And they also right now are running comparable store growth of in the high single digits. That is that business or locations in business for a year or more are growing in the high single digits, which then you add additional locations. They're looking at low double-digit growth going forward. Next slide. Again, this chart says about the best thing that I can say about Texas Roadhouse and the keeping it simple approach, up, straight, and parallel, as the Mid-Michigan mantra goes. And you can see pre-tax profit on sales and return on equity, both with the exception of the COVID year, headed up and currently above the average for the last 5 years. Next slide. Here are my judgments. 10% growth, sales growth going forward. That's close to a no-brainer because it pretty much tracks what the company is saying. It's what the history says. And Value Line, which is the major analyst that follows the company, Morningstar does not, also finds 10% to be reasonable. I chose to be more conservative on profit margins, perhaps, than both the company and Value Line and analysts are. They're projecting a fairly significant higher profit margin, which certainly could happen. But the latest conference or the latest earnings call, the company did talk at some length about the pressures that they're facing with the inflationary food, particularly in their protein costs. And then that leads to $5.42 earnings per share. Next slide. And if you use a 30 PE, you get an annualized rate of return of 16.7. That falls to 13% using the average of 25.5, and manifests par using the consensus of the manifest analysts is significantly higher. So again, I think that there's a potential surprise and upside to Texas Roadhouse.
Very cool. Thanks, Cy, and thanks for avoiding the pictures, which would have only made us all hungry. All right. We asked Matt Spielman to check in with a repeat performance. This afternoon he covered in greater detail some of the opportunities in electric vehicles, and we've asked him to go ahead and continue that with a little bit of an executive summary and make sure that we consider this topic for the roundtable also. So take us away, Matt.
Yeah, thanks, Mark. So last week we had a really good discussion about electric vehicles, and I separate electric vehicles from autonomous vehicles, which they're very related. There's a lot of overlap, but to say it this way, the old geometry saying about rectangles and squares. So not every electric car is autonomous, but just about, I'll say, all autonomous vehicles, at least production intent autonomous vehicles at this point, are electric. So we're not talking about that second part. But even so, we came, I think, to the conclusion, I think we made a good case last week, that this is something, right? This is not going away. This is not a flash in the pan. This is not the GM EV1, which will be done. In fact, Tesla this year will have manufacturing capacity by the end of the year of 2 million cars a year. That doesn't put them in any kind of position to be the #1 automaker in the world, but it is significant. But on the other hand, someone looking to invest in this space, once you're excited about it, will look at a large number of names you've never heard of, or names that may have gone public in a SPAC just a year or two ago, and see that it's impossible to do an SSG on them. They have not only no history, but if it is a history, it's a history of losses. So how would you invest in this industry change, but in a way that doesn't feel like gambling, that isn't all or nothing, depending on whether tomorrow's headline is either a major order, a major partner, or a going concern notice from the auditor. Next page. So I thought on that in between the weeks and came to a pretty quick conclusion looking at Borg Warner. Maybe a different kind of disclosure. I do have a number of friends who work at Borg Warner, a number of them from different acquisitions they've made in the last year, and I'll talk about that a little bit more. But they are a formidable automotive supplier, even if you haven't heard of them. They work with just about every major OEM. And work in the area of engines and transmissions, so all that sort of fossil fuel stuff. They started as Warner Gear in Muncie, Indiana. Sorry, Muncie. One of a number of automotive suppliers out of mid-sized Indiana towns that have come in. And you can see just a sampling of their primary products. And I'll say the primary products they had a decade ago and still have now. So transmission obviously was in their name. Fuel injection, which was several major steps to increase fuel economy with fossil fuels. Engine control, fuel handling, and not shown here are also turbochargers. So in some senses, looking at a supplier position as electric vehicles come on, they almost have the most to lose, right? Electrical vehicles are looking to replace nearly every single thing on this page. Next page. So what they've done, and I'll show you how long they've been doing that, is they've built a portfolio of essentially equivalents for electric vehicles. Some of them are very direct. In the upper right-hand corner, you'll see electric vehicle transmissions. You might not think of EVs as transmissions. You may think that electric motors are pretty simple, but particularly trucks will actually have gears. Now, not as complex as what is done today in the name of fuel efficiency, but they will need it particularly for towing capacity. But also electric motors themselves, what they call electric drive modules, so sort of everything that goes around a motor connected to the car, and then all the electronics around it. power electronics to talk about the acceleration, thermal management to make sure things don't overheat. We don't want those batteries overheated, and even battery systems themselves, installing full batteries for the vehicles, as well as what's in kind of the middle left, charging stations outside. So building a full portfolio. Next page. So they've been doing this. They've been a serial acquirer, and this is just starting in 2015. These slides, by the way, are from the current investor deck, the Q2 2022 investor deck. But you can see a very steady progression of acquisitions, and on the right you can see what that means to them. So this will carry over to the next page, but we'll talk about an expected content in 2025 of over $2,500. What they had organically, both from their portfolio just before this this spree went on, and also what they dealt before, is only about 500 of that. So about a fifth of the amount they expect to have, they had in-house or have developed from in-house technologies, and about 80% of it they've gone out and acquired. Now, I'll also say, for those not familiar with the automotive, which sometimes we can forget that, we talk about, and you'll see in a lot of slides here, 2025. That may still seem far away, but I'll say how the automotive industry, which is a long cycle time industry, usually works. And not to say surprises can't happen, but in terms of customer intent and actual production vehicles, 2025 should be pretty well cemented by the end of this year. So that's actually pretty immediate, given the point where we're talking about this information. Next page. So this is the opportunity for Borg Warner. Again, they came up really under the hood in engines and transmissions. You can see their expectation in 2025 was about $900 of content per vehicle that they won. If you recall from the prior slide, before they started making these acquisitions, they only had about $500 in-house. So they were looking at being cut in content almost in half. So that gave them some immediacy in why they wanted to act. And you can see here growth not only with all electric, but also hybrid on the way, looking to leverage their portfolio to increase their value per car, not needing the automotive industry, that means the cars delivered to increase, but actually increasing their value per car as the propulsion mode changes. Next page. So this is a little bit higher view, and like I said, 2025 for the automotive industry is right around the corner, going from less than 3% of sales in 2021 to 25% in 2025, which should largely be plans put in place at least this year, and then up to 45% in 2030. Now 2030 is important because there are a number of things in there. Many EU countries, for example, have mandated that only electric vehicles will be sold new in those countries by 2030. Of course, there are also companies. GM has pledged to sell only electric vehicles by that as well. So, those can always change, but the commitments are there. So in any case, there's a solid case to say, based on the volumes that they have today, that that's at least an achievable number. Next page. This is one other thing. So you say, well, how is it going to be Borg Warner when GM rolls out their technology for what they have, or Ford or Tesla or anyone else? And even Tesla, as secretive as it is about its supply base, does rely on suppliers for a number of things. So this is a little bit under the hood as well to say, the OEMs gain the spotlight for their platform, if you will, but they still have a lot of supply content inside. And you can see the gearbox in the upper right is probably the least amount, because a lot of OEMs bring transmission experience to the table. And so that's not only engineering know-how or patents, it's also plants building transmissions today. Something that for an existing company would be a headache to reduce, so why not put that to work? But you can see here an expectation for Borg Warner, but really on an industry basis of what things are going to remain in-house and what things are opportunities for suppliers to provide, no matter who wins the race for electric cars. Next page. This is going back to the idea of them being a serial acquirer. You can see in the time frame up to 2025, they expect to generate $7 billion in capital, largely free cash flow, but also some other portfolio moves they're moving out of. And a large majority of that, and this is again not including anything they've done so far, this is looking forward, They're expecting to have another $5 billion for more acquisitions to drive this. So they have a lot of horsepower, if you will, a lot of firepower to put in place and continue to fill their portfolio as opportunities arise and as the picture becomes clearer about just what the needs will be and what the acceptance of electric cars are going to be in the public. So looking at the SSG, and I didn't put my judgments in here, but I have turned on the analyst estimates. You can see analyst estimates, 10% sales grower. It is automotive, so you do see some cyclicality here. 2016 was not taxes, but I will say that Value Line's core earnings don't show that blip there, and also you see it wasn't driven by revenue. So a very nice revenue line for the cyclical industry. 2020, 2021 hit somewhat. Certainly there are a lot of supply chain issues, cost issues. I would call that well managed in an industry that for 2 years has been capacity constrained, that has had a number of plant closures because you can't get parts. And it's not just the microchips that happen. If you don't have the chips to have an engine controller, you don't build the whole car. So that impacts all suppliers. But not only are the analyst consensus estimates there, I've also put in Value Line's estimate for revenue and earnings per share in 2026, the midpoint of their range, right in line with that. So several years of expected growth, not out of this world, particularly understanding that they're acquiring, but very solid. Next page. Looking at Manifest, again, very nice par, 16.5%, high quality, 88. The Manifest data shows a slightly slower sales growth forecast, but I'll say a little bit higher PE ratio than I have. If you are looking at this company doing your own SSG, beware of the PEs for 2016 when they had that earnings dip, but their stock price was supported, so it was well explained, that went through. And of course, last year, as earnings have been depressed with increased costs, the PE is a little bit high. So my PE personally was a little bit lower, but my growth is in line with analyst estimates, and my par in my SSG is right in line with this. Next page. Looking at our external references, and so this is a little bit old, the Value Line from March, but the price today was 39, so no change in price. Good news is if you're going to look into the stock, you'll get a fresh Value Line in a couple weeks. I look at the Value Line low projection again as a solid company in line with a Manifest par, and look at the high projection as your electric car option. Should things go better than we might expect, you have the potential to be well rewarded. If things stay more like they are today, you'll do just fine anyway. And Morningstar with a 5-star rating right now. Next page. So if you're thinking about it more in the line of discounted cash flow, you need to think of the possible scenarios, right? And this is where I get back to, is this a gamble or not? So if things blow up in this industry, and that doesn't have to mean that we only use gas cars afterwards. This could simply be a 2-year delay. Maybe the EU delays its mandate because they're having some economic issues and don't want that upheaval. Maybe there's a point where there's a string of issues with one particular OEM and their battery pack, and the insurance industry stops to think and maybe raises rates for a while until things are clear. A lot of these companies are not only young, but they're fairly aggressively capitalized, and even a delay of 2 or 3 years, which is not uncommon in the auto industry. It's a long cycle time industry, could be existential for them. Now, Tesla and Waymo are going to survive. They're a little bit further away from the explosion, but would Tesla have the high PE it would have if it found that it wasn't growing its demand to meet its capacity increases? Waymo has its deep-pocketed parent, Alphabet. But at what point does Alphabet continue to have interest in what Waymo is doing if there are others in the industry that has problems? One more click, Mark. So I go back to the point, the very first slide I had. Borg Warner has not given up on its existing portfolio. In fact, if you look at its patent applications, there are quite a few patents still going on, particularly in the turbocharger space. So it will do well today with today's items. However, the electric industry either does or does not meet its hype, it will also do well tomorrow in a more electric world, whatever that is. I think that's it.
It's a pretty good hedge. Got both sides covered. Good stuff. Thank you, Matt.
Yep.
All right. Well, I went shopping for companies as usual. I'm looking for a little bit of a special situation here. Basically pulled in companies that have decent return forecasts, in most cases decent quality, double-digit projected returns on value. And again, the analyst community thinks most of these companies are pretty much on sale. Magnite is an advertising company. Boston Beer, you've already heard about. Target, which is going to be my selection, has pretty good numbers across the board, just not quite as ambitious as others. DMC Global is actually an infrastructure play and in the construction business. Ryanair recently cited as a very promising airline out of Ireland. Many of you are familiar with that company and some of the advantages in Europe. Amazon, pretty beat up recently, along with some of the other companies like Google. Rocket companies, kind of an uncertain outlook for the next several months thanks to what's happening to the mortgage industry, but longer term, who knows? It could be pretty interesting. And last but not least, Dutch Brothers, a competitor to Starbucks that actually showed up in a number of groundhog portfolios this year, and could be an interesting situation. The interesting thing that happened just a few days ago was Target came in with slightly weak results. They were not terrible. They were a little bit off, kind of off to the magnitude of Ken's Google a few months ago, only Target picked the wrong day to actually tell everybody. And you can see that the stock price basically was chopped by 30 or 40% virtually overnight. It's a theme we've been talking about a lot lately during our bull sessions and some of the various sessions that we have done, that I think we're in this mode where the actual stock price of companies moves much more erratically and dramatically than the value of the company. Target's a pretty well-established company, very well managed, and they probably don't deserve the type of price volatility that we're seeing. That could spell potential opportunity. What happened? We basically had a slight reduction. They basically tapped the brakes on the economy, and consumer spending slowed down, in addition to the other inflationary concerns and supply chain and all that kind of stuff that's going on. Sticking with tonight's theme, with Tom Cruise there, you hit the brakes and you basically have that line from the movie. I think you're seeing that type of a thing with Target. I mean, you look at the spending graph up at the top, show me the reduction. I mean, we basically slipped back slightly below zero. It's not an unusual condition. You're looking at the last few years on a month-over-month basis on the lower right there. It's really not that unusual, yet the reaction is extreme and severe right now for retailers. And so I think that there could be some pretty good situations ahead for firms like Walmart and Target, Amazon. And this is the actual report from Value Line, their supplemental report. It explains that they came in slightly under the projections, more than usual, and probably picked one of the worst days to do it when everybody's getting punished. I really think that we should offer get-out-of-jail-free cards and people can skip earnings reports when the environment is as nasty as it has been here over the last few weeks. But I'm struck by that statement at the end, that the price reduction basically becomes an enticing entry point for long-term accounts. And yeah, there's going to be opportunities to continue to accumulate. I think of Hugh McManus and people like Ken Janke who would basically begin accumulating a stock like this, and as the price languished or even dropped further, you just simply accumulate for a while. If you have the expectation that it's going to be okay in the long run. And I think that Target basically qualifies for that type of perspective. Here's a look at the company longer term. They basically retrenched and retooled back a few years ago. They continue to expand now with some of their food service options and all that kind of stuff. The stores are quite productive. They're optimizing them to their best of ability. And you basically see a projected return on value that's in the upper teens that would be comparable to a par somewhere around 20. Again, an improving picture over the long term, speed bump is real. It hurts. It certainly has damaged the stock price, but I believe it's created an opportunity for us to become owners of the company. So with that, I'll add that to the pile, and Ken, we can go to the poll.
Okay, thank you, Mark. Give me just a moment here to launch the poll.
Would you say that Target has a target on its back?
Well,
Mark?
I figured, I didn't want to overuse the metaphors tonight, but
And here's our poll, folks. Which one of the four stocks that we presented, and I see I have a typo in the word target there.
thanks,
Which one
Ken.
of the four would you, you're welcome, Mark. Which one of the four would you like to add to the portfolio? Or if you don't like any of them, pick none of the above. And we'll try to get our responses going here. We'd love to have 85, 90% of you voting. We're up to just under 70% voting right now. So keep those votes coming in, folks. Let's try to get her up to 85 at least, okay? We just pushed it to 80%. We need another dozen or so votes here to push it to 85%. And there we go. I'm going to count down in my mind from 10. And I'm going to close the poll, and let's display the results, okay? And here's the results. And it looks like we're going to add 2 positions in Google tonight. Borg Warner had a quarter of the votes. Target 16%, Texas Roadhouse 10%. A few folks didn't like any of them, so there we go. But a double position in Google this evening, Mark.
Sounds good. Yeah, I think that Google's making a run at the cognizant technology position in the portfolio. It'll be interesting to see how those two sort out over time. And one thing I will point out is all of the selections made last month are doing quite well. And Generac is still a pretty good study. I thought about bringing Generac again tonight, especially since we've talked over the last week about how the probability of outages in Michigan are a reality for this coming summer. So if you're not familiar with the company Generac, I would encourage you as an investor to at least be aware of it. Houlihan Lokey was a really good one too. And of course, Ken is in love with the bank there.
Sharon Lindquist has asked, has none of the above ever won? And Sharon, it's never gotten over 5%. So we're at least picking stocks that people like enough to choose one of the stocks we're picking here.
Yeah, and last month all of the above might have won.
Yeah, if we would have had all of the above, we got a lot of comments to that effect last month.
All right, here's just a reminder that we do on YouTube. If you go to YouTube and you just search on Manifest Investing and Roundtable, we do archive all of the sessions, whether they're bull sessions or roundtables or educational sessions. There are some shorts there on some topics and companies. Just wish to encourage you to check it out. If you subscribe, and we would love for you to subscribe, we'll make you aware anytime that new content is added.
We have a hand in the air from Janet. Janet, you're muted on your end, but if you'd like to ask a question, you'll need to unmute yourself. I'm going to assume that that's an inadvertent hand. And Mark, with that, Matt, I want to thank you a lot for keeping up with some of the questions. It really helps to have a second person typing in the background. And Mark, we've basically kept up pretty well with most of the questions this evening, so we don't have a lot to carry over into an after session.
Okay, well, we'll go ahead and close things down, and we'll post some of the selling decisions on the Manifest Forum. And thanks everybody for attending. Get out there and enjoy your summer. The summer is now officially commenced post Memorial Day, so. Yeah. Get out there and enjoy.
A big thank you to Cy and to Matt and Mark, to you as well. As always, we can't do this without all the help you give. Thanks for coming, folks, and we'll see you in a month.
Thanks, everybody.
All right. Thanks. Good night, all.